Real estate taxation forms one of the most important financial structures in property ownership and local government funding. In earlier chapters, you learned how investment value, financing, and ownership shape a real estate transaction. This chapter builds on that knowledge by exploring how real estate is taxed, not as income or gain, but as property itself. Understanding how taxing entities operate, how tax districts are created, and how property taxes are assessed prepares you to guide buyers and sellers more effectively in any real estate market across the nation. Real estate property taxes are imposed by taxing entities, or taxing districts, at the county and local levels. These taxes fund essential community services, such as education, emergency response, public safety, parks, and infrastructure. Although real estate taxation may seem straightforward at first glance, it is shaped by layers of government authority, local needs, and constitutional limitations that every national level real estate professional should understand. Taxing entities. Real estate taxation refers to the taxation of real estate as property, not as income, not as investment gain, and not as personal wealth. Property taxes are levied on land and improvements for the purpose of funding local government services. The authority to levy these taxes depends on the level of government involved. The United States Constitution prohibits the federal government from imposing taxes directly on real property. As a result, there are no federal property taxes on land or improvements. However, the federal government does tax income produced from real estate and any gains realized when property is sold. In cases where federal taxes are unpaid, the Internal Revenue Service can place a tax lien on the property. But this is a collection mechanism, not a property tax. State government states hold the constitutional authority to tax real property, but most states delegate this responsibility to local governments such as counties, municipalities, townships, and local taxing bodies. Some states impose limits on how local governments may set tax rates or levy assessments. States may also place tax liens against property for failure to pay any state-imposed property tax or any taxes the state has delegated to local jurisdictions. County and local government. Counties, municipalities, cities, and townships play the primary role in levying real estate property taxes. These local governments rely heavily on property taxes to fund vital community services, including public safety, schools, transportation infrastructure, libraries, and water or sewer systems. In many areas, the county government is responsible for collecting all property taxes and distributing the appropriate shares to each local taxing body. Because local governments frequently bundle taxation for multiple services, a single property tax bill may include levies from numerous tax districts, each representing a specific public service or purpose. Tax districts. Tax districts are geographic areas established by local governments for the purpose of collecting funds to support specific public services. These districts operate independently of municipal boundaries, meaning a property may lie in a particular school district or park district, even if it falls outside certain city limits. Property owners contribute to these districts through taxes levied on real estate located within the district boundaries. The school district is typically the largest and most significant tax district, often accounting for the largest portion of a property owner's total tax bill. Other common tax districts include fire protection districts, community college districts, library districts, park districts, water districts, public health districts, and road or bridge districts. A typical property tax bill may include levies from multiple districts, such as Bridge and Highway Fire District School, District Storm, Water Management, Township Public Library, Community College Forest Preserve, or Land Management Park District Health Services, Nursing Home, Historical Museum Retirement Fund, Sanatorium services beyond these standard districts. Local governments may establish special tax districts for specific improvements that benefit a targeted area. These districts are temporary and dissolve once the improvement has been fully paid for. Examples include extending water lines to a new subdivision, upgrading street lighting in a commercial zone, or installing sewer systems in a newly annexed area. Special tax districts are project-focused and typically expire once the improvement is complete. This differs from permanent tax districts, which fund ongoing community services. Review summary. Real estate property taxes are imposed at the county and local levels, never at the federal level. States hold the legal authority to tax real property, but usually delegate this power to local jurisdictions. Property taxes are a primary revenue source for essential community services. Tax districts, both permanent and temporary, are created to support specific local functions, such as education, fire protection, parks, libraries, and infrastructure improvements. Understanding these taxing entities helps salespersons explain property tax obligations and evaluate the financial impact of taxes on ownership. Discussion: why do property taxes vary so much from one community to another? Answer: property taxes differ based on local budgets, tax district needs, and the number and size of taxing entities serving the area. Why is it important for buyers to understand which tax districts a property falls within? Answer: tax district boundaries determine the total property tax burden. Two similar properties may have very different tax bills depending on district placement. Why does the federal government not tax real property directly? Answer: the United States Constitution prohibits federal taxation of land and improvements as property. How does a special tax district differ from a permanent tax district? Answer: special tax districts are temporary and created for specific improvements, while permanent tax districts support ongoing community services. Closing remarks. Property taxation is one of the most significant ongoing expenses for property owners, and understanding how taxing entities function strengthens your ability to guide buyers and sellers through financial decision-making. As you move deeper into real estate tax concepts, you will see how assessments, levies, equalization, and tax rates combine to determine the actual tax bill for any property. This foundational knowledge sets the stage for the next sections of the chapter, where the mechanics of valuation and assessment will be explored in greater detail.